Disclaimer: this video is only for educational purposes and not an investment or trading advice by any means. Any stock discussed is purely an academic exercise without any recommendation or commercial interest. Scientific investing as well as presenters may or may not have any investing or trading positions in the stocks discussed. During this video, we don't hold any responsibility for anyone's investing or trading losses. Please do your own due diligence or consult your financial advisor. Hello viewers, welcome to Scientific Investing, and I'm here with a new video. Before that, in case you have not subscribed to our channel, do subscribe and do like so that it reaches to more and more people. Now coming to today's video, so on Saturday, I had posted a message on the community that I'm going to make a video on the topic, can Zomato trade at tomato prices? And this was done on Saturday. I was supposed to make this video on Sunday, but somehow I was not keeping well, and hence there was one day of delay, and today I'm here with video. But during this one day, what has happened is Zomato's prices have fallen from 115 rupees to almost 91, 93 rupees, which means today the price fell almost 19-20%. So it becomes more interesting with that context, that can Zomato really fall below the price of tomato? And why I'm asking this question, let us try to analyze together and let us go through the numbers and see. So let us try to understand what kind of business Zomato in, and as most of us, we order food from Zomato. So basically they're in food delivery business, but there are two types of food delivery business. One is platform to consumer delivery and second is restaurant to consumer delivery. Now the difference between these two is, in a restaurant to consumer delivery, it is the restaurants who have their own app or own website, and customers, they go to those specific restaurant and their website or their app and they order the food. And in this model, the menu is limited to what the restaurant is offering, and also the delivery of the food, the overall logistics of managing the delivery, that is taken care by the restaurant. So like if you go to a Domino's app and you order directly from Domino's, it is the Domino's person who will come and who will deliver the pizza for you. Whereas in a platform to consumer, basically you have an app which is an aggregator of multiple restaurants and food joints, and you have wide choice to select from multiple restaurants based on various options like your distance and cuisine type and all, and then you order food. And here it is the aggregator, the platform aggregator, which takes care of delivering the food. So the job of restaurant is just to prepare the food and provide, and the aggregators person goes there, collects and delivers to the customer. So these are the two differences, and Zomato is in platform to consumer delivery model. Now, what is interesting is, so let's say platform to consumer, let's call it P2C, and restaurant to consumer, let's call it R2C. If we look at this market, how this market has grown, and if we look at the data from FY16 to FY 2020, and if we try to go through the projections for next 5 years, what we see is it used to be a $4.7 billion, US $4.7 billion market, which has increased to $10.2 billion, which means it already doubled, more than doubled. And 16.4 billion was the pre-COVID estimates for 2025, but the latest estimates post-COVID is 18.1 billion US dollars. But what is interesting is when we break these numbers in terms of P2C and R2C, in 2016, out of this $4.7 billion, only $0.3 billion market was there with P2C, which is where companies like Zomato and Swiggy are. $4.4 billion market was still with the restaurants who used to directly deliver the food through the app or website. But what has happened in 2020, the $0.3 billion P2C market has grown at $4.8 billion, which is almost 15-16 times growth. So in 4 years this market has grown 15-16 times, whereas your R2C has shown decent growth from 4.4 to 5.4. So it will not be surprising that there are companies which have grown at 100, 200, 300%, when in 4 years this whole market for the P2C has grown 15-16 times. But when we look at the estimates 5 year forward, this market, though it will surpass the R2C, The P2C market is expected to go from 4.8 billion US dollars to 9.7, which is like almost doubling in 5 years, which is like your 15% growth rate. So the future projections are not that great, just mind it. And the past, the development, the past growth has been, humongous. So let's keep that in mind, and we'll come back to this point. So given now you understand what Zomato does, what is the market size, how the market has grown, and the Zomato's growth vis-a-vis. So it's not surprising when you see the revenue growth rate of Zomato, which has been almost 182% in 2019 and 98% in 2020. And the thing is, Zomato is not making profit. So if you look at the operating margin, the Zomato's operating margin is improving, but still it is negative and highly negative. So from 174% to 92%, all negative, to minus 30%. So minus 174, minus 92, minus 30, and right now they are somewhere around minus 42% operating margin. So first thing, it is not a profit-making business. The revenue was growing at a very high rate, but in 2021 it took a pause, and again it has grown, and again it is growing around 50%. But the operating margins are negative, and still around 30 to minus 30 to minus 40%. So the question is if Zomato has to become profitable, because ultimately at the end of the day, there is no business which can, if a business has to be valued, it has to be valued on profitability. And if it is getting, billion-dollar valuation and all, somebody is expecting business to make profit, and then, they are paying the valuation. So if Zomato has to become profitable, that will happen through two ways. One, through the revenue growth, which will help them to break even, where they will have some kind of fixed cost, variable cost, and with higher revenue growth rate, they'll come to a break-even point. Or the second way is cost cutting, where they need to cut some of the expenses and improve their margins. These are basically two ways how the Zomato's profit pool can be created. Now, if we look at the major expenses which Zomato has, and if we look at the trend from 2017 till 2021, we see there has been an improvement. Like your employee expenses, it is coming down from 86% of revenue to 62%, 46% in COVID, because their revenue took a hit. Again, it has worsened, and now it is around 37%, which is almost one third. The second item, which is the subcontracted or outsourced services, like, if they have to get the food delivered, maybe they will outsource it to somebody. So that is another 30%. And advertising and sales promotion, that's a major cost, which is another 26%. And in fact, in previous year, it was almost 51%, and before that, 94%. So looks like they are slowly reducing the expenses, but still these three constitute almost one third of the overall expenses. And until unless they go for cost cutting, which means they are going to reduce some employees, advertising and sales promotion is one area where it looks, if they feel that they have acquired the customer, they don't need to spend on customer acquisition, and they can try to, improve. But these are the three ways where, bulk of the revenue expenses are going, and they need to improve one of the three if they really need to be profitable. Which given we don't have any other such company in India, and how to find it, how to value it. So, whenever we get a very new kind of business model in India, we go to the US, we go to the China, because those are the developed economies, and you may have seen similar companies there. So we also tried to go to the US and go to the China and find who are the peers of Zomato trading. So I found one company in US, which is like the most popular company in food delivery, which is a Doordash. And you can see Doordash is into on-demand food delivery services, and the same kind of model the person delivers. The second company I have picked from China, which is Mituan, and Mituan is the number one company in China, which is again in this whole food delivery e-commerce business. And let us go through now the numbers of these companies. So if you look at Doordash IPO came somewhere around 1 year back, and actually, it has given almost minus 40% return. So yes, the stock is 40% down, and in fact, the stock created a low around 110 rupees. It created a high around 250 rupees in November 2021, and in a span of 2 months in US, it has fallen from 250 rupees to 110, 115 rupees. Which is obvious the way, there are many next gen businesses in US, they are falling. In fact, NASDAQ is almost 4.5% down today. So yeah, that is what Doordash has done. Not a great performance, minus 40% down. If we look at Mituan, So Mituan came somewhere in April 2019, and from there the stock from around 60-70 rupees, the stock went and made a high of 400 plus rupees, I think 420, 430. But then again, since Jan 2021 and last 1 year, this has also corrected. And from 410, 420, now this is trading at 200 rupees. But still from the IPO price, the stock has generated very decent return. In fact, the 3-year CAGR is almost 76, 73%. So, mixed responses, Doordash versus Mituan. But now let us try to see how the numbers of these two companies look like and how can we compare it with Zomato numbers. So though I'm giving you the detailed P&L, numbers, but I will try to simplify. And all these numbers which you are seeing, or the stock prices which you are seeing, all these numbers I have tried to pull from Ticker, because I know many of you are aware of Screener, but Screener covers only Indian companies. But when you need to cover the international companies, Ticker is like the best tool I go for. And in fact, I made a video on Ticker 2-3 months back. And if you want to check the video, how to use Ticker for international stock research, or even to find the global screener and screen companies, how to do that. To do watch that Ticker video, it's there at at the top. The link is there. Now coming to Doordash, Mituan, and Zomato. So the first thing, because it's all the game of eyeballs and top line, how their top lines have grown. And if we look Doordash last 3-4 years, growing at 200%, 226%, and now the growth is around 55%. So the growth has slowed down, but they had this 200 kind of growth curve. If we look at Mituan looks like was going through a high growth curve in 2016-17 at 161%, then gradually 91, then 49, and they also didn't do really well in 2020, still positive 18%, and now again in last 12 months they've grown at 45%. So both companies from a triple digit growth rate, they have come down to double digit growth rate, but still they're growing at 40-50%. Now, when we look at Zomato, the Zomato also went through, that same 182% to 26% growth rate. And now Zomato is also down to a lower growth rate, where in last year they were degrowing, but again, the growth rate has come, and again, they're growing in the mid double digit, growth rate. So growth rate wise, okay, these companies, they look a bit similar to each other, though, your Doordash had very high growth rate in some of the initial years. Now it becomes interesting when we look at the operating margin. And when we look at the operating margin, what we see, Doordash in 2018, they had minus 72% operating margin. But see, last 2 years, like 2020 and last 12 months, they have been able to reduce the operating margin losses from minus 72% to minus 14%, and it is hovering around minus 13, minus 14%. Mituan is even better, because Mituan in 2018 itself, they were operating on minus 18% operating margin. And if you look, almost they were in profit. 2020, they were at minus 3% operating margin. 2021, they were almost like 0% operating margin, which means almost break even. And last 12 months, they are hovering around minus 4%. Now, this is where Zomato is far behind, because when we look at Zomato's operating margin from minus 174% to minus 91%, Zomato is still around minus 42% operating margin, which is like way higher than where Doordash or where Mituan is. So we can surely say growth wise, they might be overall comparable, but when it comes to operating margin, Zomato is far behind. Now, let us look at one more metric. So now we are looking at something, because operating margin, all of this is P&L. But if we look at cash flow wise, what is happening, and this is more interesting, because 2018, 2019, Doordash was making losses, and hence your cash flow as a percentage of sales was almost minus 50% plus. But when you look in 2020, last 12 months, actually in terms of cash flow, Doordash is profitable. And I will tell you why it happens, because a lot of these US companies, they pay a lot of stock options to their employees. So when you will see in the P&L, they will expense out the whole stock option, but actually they will not encash that transaction. So when you see in the cash flow, the positive value of that makes, even though the P&L is negative, your cash flows are positive. So that is what is happening in Doordash. And actually in terms of cash flow, Doordash is generating 9% cash flow from operations with respect to sales. Mituan is also there at the same place, where, in 2018, they were like minus 14%. But in 2019, 2020, they were almost 6 to 7% of cash flow to sales. And now also they're almost there, a little bit negative. But when we see Zomato's cash flow, we see it is reducing, but still, almost 40, the cash flow is not positive, and they are at minus 42% cash flow to sales, which means on every 1 rupee of sale, there is a minus 0.4 rupee loss, cash loss, whereas the other two companies, their cash profit. So now, given we have the sense of growth, we have the sense of margin, we have sense of actual profit. If we look at the valuation, and I can't value in terms of cash flows because Zomato is negative. So all we can do is we can look through the price to sales ratio metric. And if we look at Doordash trades around 9.8, 10 times price to sales. Mituan trades around 6.7, and that could be attributed to because we have seen that Mituan profitability has fallen, and revenue growth has fallen. And once you come down to normal revenue growth rate, then the operating leverage and all is gone. Then it's all about cost cutting, and that becomes your stable margin. If we see Zomato trades at 50 times price to sales. Whereas they don't have differential growth rate. Zomato has not done anything great on top line growth rate. If we look at the future looks more bleak if we go believe by the numbers, and those numbers are published in some of the DHRPs which have come, published by, one of the leading agencies, research companies in the FMCG space. So the future growth rate is lower. The operating margins are poorer. The cash flow is negative, whereas the other two companies, they're positive cash flow from operation, but the valuation is almost 5 to 7 or 8 times more than these two companies. So what can happen? Let us think of the scenarios from valuation perspective. So the first thing, Zomato, because I told I'll make this video, on Monday, and on Saturday, Friday, the stock was around 113 rupees, which was around 1 lakh crore market cap. So I have taken that numbers from there. These numbers have fallen by 20%. So now it's around, 80,000 crore or something. But for Zomato, let's go back and assume it was 113 rupees. So for Zomato to trade at 1 lakh market cap, assuming they get valuation of Mituan, which is 7 price to sales, because Mituan is doing better on the top line, bottom line, margin, cash profit. If Zomato trades, at 7 times price to sales ratio, like Mituan, and still this current valuation need to get retained, then it means its current sales number needs to go from 2,600 crore, which was the peak revenue number pre-COVID. From 2,600 crore, this number needs to go to 14,000 crore, which means the revenue needs to grow at almost 500%. Can Zomato do it with projected 15% growth rate in the market, or how it will do it? I leave the question up to you. Let's say the second scenario. Let us say if Zomato grows the revenue at 40% CAGR for next 5 years, and Zomato after 5 years, it deserves the valuation of Mituan, because this is how Mituan is maturing in terms of, you can see the revenue curve coming to profitability, and this is the kind of price to sales they're garnering. So if Zomato grows at 40% revenue CAGR for 5 years, and then it gets the same valuation of Mituan, which is 7 price to sales ratio, then Zomato will still trade at today's valuation, and actually today's valuation's fallen. Now it will be in loss, but still assuming it goes back to 113 rupees, the 5-year return will be big zero. Let's take the third scenario where we take Doordash, which trades at a higher valuation, 10 price to sales ratio. If we assume that this is the best price to sales ratio Zomato can get, because I don't see a logic of 50 price to sales ratio retaining when, there are peers in the world with better technological capabilities, with better financial numbers, and with generating cash flows. They do spend some money on R&D and all. So if we assume Zomato also gets a 10 price to sales ratio, then it means that actually the 120 rupee price needs to fall to 30 rupee, which is almost a 75% fall. And that is why I raised this question: can Zomato trade below Tomato's price? Now I am leaving all these scenarios up to you to decide to take a call based on the numbers, because my job was just to give you a perspective, and you take your own call at what price Zomato should trade at. And I will see you in the next video soon. If you like this video, do like it, do subscribe our channel. If you have not, do recommend it to others, and I will see you again. Thanks for your time.